Hey, welcome to InvestTalk. I'm Justin.
And I'm Luke, and together we're your guides through the maze of investing. We'll bring you insights that will impact your portfolio.
Whether you're a seasoned investor or just getting started, we've got you covered with the latest trends, opportunities, and expert advice. We take your calls every weekday at 4 p.m. Pacific and on our anytime listener line at 888-99-CHART.
We'll bring you deep dives into market analysis and answer your burning questions.
So why join us? To get ahead in your investment journey with strategies, tips, and knowledge that will help unlock the full potential of your hard-earned money.
But first, hit subscribe and turn your notifications on, and let's make informed investment decisions together.
Welcome to InvestTalk.
This is InvestTalk, independent thinking, shared success.
Good afternoon, fellow investors, and welcome back to InvestTalk. This is our Monday, May 6, 2024 edition. I'm Justin Klein, and joined as usual on Mondays, I'm here with Luke Guerrero. Thanks for being back, Luke. How was your weekend?
My weekend was pretty good because I moved last weekend. So anytime the subsequent weekend after moving is always the best weekend of your life. You don't have to do anything.
Life is all about relativity, right? Everything's relative.
Absolutely. As our returns.
Yeah, exactly. As our returns. Most people don't realize that market returns are not adjusted for inflation. And therefore, a lot of times they think the market's doing better than reality. So that's just one little piece of advice we give on this show is things that can help you adjust your mindset so you can make better decisions with your money and understand what's happening in markets in context to everything else that's going around it. There's a lot to unpack each and every weekday on this show. And our job is to answer your finance and investment questions and give you actionable material, actionable data so that you can take that back to your particular situation and make better decisions with your money. Not just one time, but week after week, month after month, and year after year. Now, we're going to dig into the market performance for today as well as run down some show topics, but right after we tackle our first caller question now.
Thanks for everything you do on the show. I have a question about Old Dominion Freight Lines. I recently picked up some shares, and now the position is down about 20%. I was just wondering if you're seeing anything negative in the news. What's the outlook for this company? I can't seem to find any news that suggests that their financials are down or that there's negative news. Just wondering what your take is at this current level. Thanks very much. Bye.
Well, the negative news on Old Dominion was earnings, and they weren't that bad. Revenue was up 1%, earnings were up 4% year over year. But when you're trading at a mid to high 30s multiple of earnings, just a mild miss on earnings can really bring you down a peg, and that's what's happening with the valuation. It's coming back down. And we've talked about Old Dominion a few times. It's frankly one of the best businesses you can find out there in the marketplace with very high return on equity, return on invested capital, no debt on its balance sheet, and just a solid cash flow performer. But, Luke, it was trading at pretty high multiples, and that's what I think is happening here. But, should you dump it just because he's down? Do you think he should dump it just because he's down 20%?
No, I mean, at the end of the day, a good business is a good business. We say this all the time, that it's not just about being a good business. It's about getting a good business at a good price. Mm-hmm. And certainly Old Dominion was a little bit inflated on its valuation. I think it still is now, given forward-looking guidance. It's trading at a price to earnings of 28. But if you're a long-term investor, this shouldn't scare you. This seems to me like some intermittent volatility just associated with more depressed demand that's dragged earnings down just slightly. But nothing really, to me, that I can see that's very alarming about how the company is run. Just seems to me like a point in time overvaluation issue.
Yeah, exactly. You just had a bad timing. You bought it after a run, and now it's coming back down to reversion to the mean, I think, from a long-term perspective. And it probably is headed towards about the 170 level. That's where the next major support level is, and then down at 156. And I think because it's at 156, I think that's clearly in a range where it's a pretty decent value, and that's what you're looking for. You're never going to get these names super cheap. You're not going to buy this for a single-digit P ratio. Most companies who have single-digit P ratios their businesses are not that great. And so you don't expect to get this at bargain basement prices, but you certainly want to pay something reasonable, and down at that 156, 157 level would be a great place to do that. Thanks for the call. That was ODFL, Old Dominion Freight Lines. Now, we have a lot of ground to cover over the next 45 minutes, and our main focus point is about the jobs data that came out on Friday. And I'm sure you talked about this a bit on Friday, Luke, but we'll dig in a little deeper to the numbers. We also have some other topics to discuss. One is in regards to 529 plans and some rules that are taking effect due to the Secure Act 2.0 Act. Sorry, Secure 2.0 Act. There we go. That's how you say it. And we're going to go over those changes and how that might affect your 529 plan that you might have placed for a child or grandchild or niece or nephew, whatever that is, and why they're becoming more attractive to invest in for your next of kin. Also, TikTok. TikTok is big, and will they be sold or won't they be sold? That's TBD. But what is certainly true is that those that are on TikTok regularly are seeing videos that shape their view towards their financial life. So we're going to dig into that, and hopefully it can not only help those that use TikTok a lot. I know I don't have TikTok on my phone, but I'm sure I know many people that do. But we're going to look at what type of kind of problems it can create with the view towards finance if you're using TikTok too much. And then lastly, IPOs. People like IPOs. They typically are exciting names to follow and interesting names that are at least hot right now. But what should you look for to invest in an IPO? Should you buy IPOs right away? What happens if they pop? What happens if they drop soon after an IPO? And we're going to look at the data there as well. But ultimately, that's what's on our mind. But most importantly, what's on your mind? We're going to get to some voice bank questions. One is on DNOW, DNOW, as well as NOA, which is North American Construction Group. We also have some comments, some questions that came in via the comment section on our InvestTalk YouTube channel. And of course, we welcome your finance and investment questions right now at 888-99-CHART. Now, we're heading into our first short break. On the other side, we'll talk about today's market activity. But please remember, you can call anytime and leave your question on the InvestTalk voice bank. If you're listening via our live stream or on AM 1220 radio in the Silicon Valley area, you can call right now at 888-99-CHART.
Do you want to take your investment strategy to the next level?
We invite you to visit InvestTalk.com and submit your portfolio for a free review from us.
This is a fantastic opportunity to receive personalized advice and insights to enhance your results.
Don't let this chance slip by. Go to InvestTalk.com, submit your portfolio, and let us help you on your journey towards greater investment success. Thank you for watching. Make sure you like, subscribe, and hit the notification bell so you never miss an episode of the InvestTalk podcast. Now, Luke, let's take a look at the market for today. We had a nice bounce, and certainly in the growth side of the market, that was where the strength was today. I think really on the back of a couple things. Obviously, a good jobs report from a Fed perspective, a Fed easing perspective on Friday. But also, I believe we had a somewhat resolution, ceasefire in the Middle East. Did I see that correctly? It seemed like it was maybe nebulous. I'm not sure. What did you see?
No, Hamas said that they accepted ceasefire proposal mediated by Egypt and Qatar actually.
Yeah, that's what I
but
saw.
Israel says they find it unacceptable, so there's no agreement as of now.
So once I got you, so I wasn't sure. I was on calls all day, so I didn't see I saw some headlines, but I didn't dig into it. What do you think that's what drove the market up, or what do you think was the driver here?
I don't know, because if you take a look at volume, total volume in the market was actually pretty low. It seemed to be a pretty quiet week, and that is ahead of the fact that there's really not much going on a macro or even a micro scale this week. Most big earnings being done, nothing really happening until next week with PPI and CPI being released. I know there's maybe consumer credit and wholesale inventories this week, but other than that, I don't really see many catalysts that could drive the market either direction, so I would just expect some low volume position taking ahead of tomorrow's updated, or rather next week's updated inflation data.
Yeah, and we have consumer sentiment on Friday. That's probably the biggest news for this week. And like you said, a lot of those mega cap tech names have already reported earnings. So, what is that driver? A lot of it's positioning. It's encouraging that we're getting a pretty strong bounce from those lows just a couple of weeks ago. And so it just shows you that, you have to look at the market, the liquidity situation as a whole. And what you see is a Fed that increasingly wants to err on the side of the doves. And you have the Treasury, which has a large Treasury general account. I think it's about 800, 900 billion. So they're able to draw that down as much as they need to in the near term. And they're issuing more on the short end. They continue to focus on the short end, and that's not really drawing much liquidity out of the market either. And so most pullbacks should be bought. Now, could we see more volatility going into quarterly OPEX in June? I think that's a possibility, but near term, you have to be modestly bullish until you get to OPEX next month. So that's where we're at, and let's pivot over and talk. Actually, let's take a voice bank question. This one came in earlier from Israel.
Hello, InvestTalk. This is Matt calling from Tel Aviv, Israel. Big fan of your show. I have a question about Avantis Mid-Cap Value ETF, AVMV. It's an actively managed fund, which I remember you mentioning as an advantage in the space. I like their sector allocation, almost 14% in energy, which is much higher than the Vanguard funds, 19% in industrials. I remember Luke saying they have a decent management team, and just want to get your opinion on buying a position in this environment for long-term hold. I'll listen to your answer on the show. Sending our best wishes to Steve. Hope he's doing better. Take care, guys. God bless.
This is the Avantis U.S. Mid-Cap Value ETF. AVMV is the symbol. And generally, we like mid-caps. Mid-caps tend to have the best risk versus reward of any of the, if you're talking about style factors, large, mid, and small, because they're not so small that their business is super volatile, but they're large enough, being a mid-cap, that they have some sort of competitive advantage typically, and some scale to them, and access to credit markets. And so but they still have room to grow because they're only mid caps, they're not large caps. And so mid caps do tend to have good risk adjusted returns long term. Then it comes down to the manager, the style that they are investing. And Luke, I know you know a lot about this fund family, and obviously I think most of their funds are value focused, correct?
Yeah, most of their funds are value focused, and they tend to tilt more towards higher profitability names as well. It looks like this fund specifically is relatively new in their suite of funds. Its first NAV record date, net asset value record date, was November 8th of last year. But year to date, it's beating its benchmark by almost 2%, and that's with a management fee of about 20 basis points. This is going to be similar, most likely, to all of their other funds. Tilt towards value, tilt towards profitability, do it in a way that has as low turnover as possible, and do it for pretty cheap. So if you're looking to get some mid-cap value exposure, this is certainly a good way to do it.
Yeah, and if you look at things like return on invested capital, the average company in this fund has about a 15.25% return on invested capital. The index is at 9%, and the category as a whole is only 7.74%. So, like you said, they tilt towards higher profitability, even though their free cash flow yield does tend to be lower. But that goes back to you're going to pay up for a quality business with economic moats and good profitability metrics. And so it makes sense. And so if you're looking for mid-cap value exposure, you can definitely do a lot worse than this one. Thanks for the call. Now we're going to a short break. Still to come, answers to caller questions, and we will take on questions submitted via our YouTube channel comment section as well. This is InvestTalk, and we encourage you to give us a call. We love talking to you live at 888-99-CHART.
The stock market is constantly changing, and serious investors want a way to get the latest news and unbiased investment insights. Welcome to the InvestTalk podcast. Enjoyed our insights on InvestTalk?
Great news. Our podcast is available on all major platforms.
Make sure to subscribe wherever you listen to your podcasts.
And get the latest in investment advice across Spotify, Apple Podcasts, and more.
Subscribe now and join our community of informed investors.
Now, our main focus point today concerns a story. Job growth took a hit in April and unemployment rose. And I know, Luke, you talked a bit about this on Friday, but let's dig into the numbers a little bit more. Expectations were for 240,000 jobs created in the month of April, and we came in at 175,000, and unemployment ticked up from 3.8, or expectations were 3.8, and it came in at 3.9. Now, most importantly for the Fed was that average hourly earnings rose only 0.2% month over month, and that's 3.9% year over year. The first time it's been below 4 for some time, and that was both of those were below consensus. And so it's pretty clear that the jobs market is cooling. Now, what's interesting is that this jobs report did not cool in many of the cyclical areas. Construction was still up, transportation, warehousing still up nicely, retail up. Social assistance up. Really, it was a drag in the government sector. Averaged 55,000 jobs a month over the previous 12 months, and last month it was only 8,000. So that was kind of carrying the day in the jobs market, was just government hiring, and that can only last for so long. And so is this a sign that the jobs market is cooling, or do you think this is a flash in the pan?
Well, I think it's difficult to say, and I think the Fed has acknowledged that. Some of the Fed governors have acknowledged that, in that there's really been a whipsaw in terms of data over the past couple months. You had some hotter than expected data the previous 2 to 3 months that had really led people to reprice if they were going to hike rates towards the end of this year or even next year. So I think in isolation, it's difficult to take any one month as being indicative of a larger trend. I think one positive on the rate cut side from this report is that average hourly earnings slowed down a little bit as well. So the primary driver at this point of inflation, really just wage inflation, has slowed down in last month. But I think it's important to note, like I said, you can't really take any one month to mean anything in particular. So it'll be interesting to see what happens this month and what the data shows when it's released next month.
Yeah, and the revisions were slightly negative net between March and February. And as you said, it's one data point, but we know the markets tend to run with data points and try to extrapolate, sometimes correctly and sometimes not so correctly. But the market has now shifted back to about 2 cuts by the end of this year. Kind of before this number, it was closer to 1.5 cuts. So certainly this is a bit more dovish for the Fed policy going forward. I think it's clear that we're starting to see a bit of weakness. You look at construction only 9,000 additional jobs. That was not great, and that typically leads the downside of the jobs market. And 175,000 jobs, not amazing, but actually kind of in that zone where it gives the Fed enough ammo to cut rates, but not so low that you're signaling a recession. And we're certainly not signaling. It's certainly not signaling that. So you kind of have a Goldilocks situation overall with this jobs report, and I think that's another reason why the market's rallying. Kind of the best of both worlds right there. Now let's go over to Sammy looking at Palantir. He is in San Francisco. Do you own it or looking to buy it?
I already own it.
Okay.
I'd like to get your thoughts on it.
Well, Palantir is a very hyped name, and you know how we typically feel about hype names. It's really about it's a data play, big data play. Obviously, their software is used in the military, but if you look at its profitability, it's profitable, but it's trading at a pretty hefty multiple. Let me ask you this: why do you own it?
I thought this stock would be a good long-term buy for the long run, given all the buzz around it and the area that it operates in. Based on my research, it seemed like something that I wanted to get in early. So I've been buying it, since it hit $15, and I bought some at 17 and some at 23 as well.
Mm-hmm.
So just wanted to get your thoughts on the current earnings report, and see if you think I should still hold on to them or maybe gradually dump them.
Well, the earnings report was pretty solid. Revenue's up 21%, earnings up 60%, but it is trading at a pretty hefty multiple. Price to sales around 26 times. Anything over 10 is typically very, very expensive. Anything over 20 is egregiously over expensive, and so that's my issue here. Now, they do have a hefty amount of cash in their balance sheet. Free cash flow at $700 million trailing 12 months puts a free cash flow yield on enterprise value somewhere in the neighborhood of 1.5. That's not good. It's pretty low. But all the business trends are positive, but you're just going to have to get so much growth at these multiples. I don't find it that attractive. But the chart, it's headed higher. So you can't really, you're not in a rush to sell it. But what I would be doing is I'd be trimming into this advance. What is your overall allocation of your portfolio to Palantir? Percentage-wise?
It's fairly small.
Okay.
I would say it is less than 1%.
Okay, so it's pretty small. That's good. I would just be trimming. What would you do, Luke? Would you just sell it all right now because it's so expensive, or just kind of trim into strength?
I would trim into strength. It's worth noting that it's up about 8% today, but it's down 8% in after hours because their forward-looking guidance was pretty bad. Came in lower than a lot of people expected. So you could see a pullback coming the next week or so as well. But I don't think you should, given your concentration in your portfolio, think you need to sell it all at once.
There you go. Now, the next InvestTalk, we'll look into this question: is it possible to see opportunities after a tough month for stocks? So we'll look at that. But give us a call now at 888-99-CHART.
Hey, welcome to InvestTalk. I'm Justin.
And I'm Luke. Together, we're here to guide you through the maze of investing and give you insights that impact your portfolio.
Whether you're a seasoned veteran or just getting started, we've got you covered. The latest trends, opportunities, and expert advice. We take your calls every weekday at 4 p.m. Pacific and anytime on our InvestTalk listener line. Just call 888-99-CHART.
We'll bring you deep dives into market analysis and answer your burning questions.
So, why join us? To get ahead in your investment journey with strategies, tips, and knowledge that can unlock the full potential of your hard-earned money.
But first, hit subscribe, turn your notifications on, and let's start making informed investment decisions together.
Welcome to InvestTalk.
I'm calling today about ticker symbol NOA, North American Construction Group. They are in the heavy construction and mining services. I was looking at their numbers. They actually look pretty good. They did miss on earnings recently, so I'm wondering if it's oversold or if it's pulled back enough. It is below all the moving averages, so if you can give me a good entry point, if you believe this is a good company and a good sector, maybe the picks and shovels of the oil and gas industry. Thank you. Have a good day. Bye.
All right, looking at North American Construction Group. It's out of Canada, and it provides services to oil, natural gas, and resource companies. So it helps with the process of mining for minerals as well as drilling for oil. And, what's interesting is it did have a great move back in July of last year, and it's just been kind of consolidating that move. And that's a positive, at least in the medium to long term. But the short term, it's definitely in a downtrend. And I worry a bit about that. And Luke, it's probably because last quarter revenues were up 22%, earnings were down 19%, and earnings expectations for this year and next year continue to come down. What else are you seeing on this name?
Yeah, well, they have pretty minimal debt, only about $535 million on a 16 or on a 504. Oh, wait, is that a $547 million market cap company? That's actually a decent amount of debt. Most of it's long term though, because their interest rate coverage ratio is 2.64, so it's not highly levered. So that's a good thing, though. Again, given its size, I might be a little worried about that debt situation. And also, in their most recent earnings report, it looks like they had some sentiment shift in terms of operating costs going forward for the first time in about 4 consecutive earnings calls. So that could be another thing that drags this company down and continues its downtrend for the short to medium term as well.
Yeah, and that's my issue is the technicals aren't really lining up with the strong business. It looks like cash from operations is an all-time high, free cash flow is an all-time high. But the chart is telling me something else. I don't need it to have a roaring chart, but I just need the downtrend to not be so powerful. And it really has since that earnings report back in March when it started at 25. Now we're down to $20.58 below all the major moving averages. It will find support probably around 19, which is the lows back in November. That's the next major support level. If you want to take a stab there with an out below 19, or call it 1850 or so, I would go for that. But I would want to see a bit of strength. I want to see this above the 20-day moving average and getting some positive momentum. So it'd be on my watch list because it is an interesting name. I don't love that debt situation, but I do like the industry that it's in. And the oil production here in North America is, especially the U.S., is at a record high. So I'm giving this one a thumbs up to be on your watch list, but not one to be buying right now. Thanks for the call. Now as you've probably noticed, we are now answering questions submitted via our YouTube channel in the comments section. So you can head over there, watch our videos each and every weekday, and leave your question. And here's one that came in from an Anarchy Utopia. I love that name. Interesting name. How do you feel about Enbridge, ENB, as a value-based oil play, thinking 3 to 5 year time horizon? Luke, Canadian oil name, what are you seeing?
Yeah, well, the first thing that's striking to me is they have a dividend yield of 7.3%, but that's been the case for over the past 5 years. So it looks like pretty sustainably they've been able to continue to pay out this dividend, and that's because their management team has been targeting around 3% dividend growth in terms of dollars per year for the foreseeable future, and they seem to be hitting that. Now, looking at its debt situation, it looks like they have about 75 billion debt on a 105 billion market cap company, and that's in Canadian dollars. That's not in US dollars. And their net margins have been pretty steadily improving. Still a lot of debt, even though it's not in US dollars, but the margins have been pretty steadily improving. Their net margin was about 14% last year, although it's supposed to dip to about 13% this year. What are you seeing from the technical side?
Technicals are pretty strong. It's hitting nearly the highest levels since the beginning of the year, but it was down most of the year. But my issue with this Enbridge has always been it's Canadia's largest natural gas distributor and gas utility. So yes, they have a lot of midstream assets and a lot of hands in the Canadian oil and gas industry, but most of their business is being a utility. And so the question is, do you want a utility or do you want an oil company? I don't want one that's a little bit of both. You buy one or the other. And so while, yes, it trades at a relatively low multiple, but it has a lot of debt. And earnings growth is minuscule. So I think here you're chasing the dividend, and the long-term returns are just not that great. This stock has been flat since 2019, beginning of early part of 2019. So you're talking about 5 years going nowhere. Just yes, you're getting that 7+% yield, but that's it. Most oil names have gone much, much higher. So it's just not a name that gets me jazzed up. I would rather own another Canadian oil name if I want a Canadian oil exposure, or if I want a utility name, I'd go buy a Canadian utility. So just kind of for me. Not a bad company, but better options out there. Thanks for the call. Now, Luke, let's talk about 529 plans. Now, if you know this, 529 plans have only been around since 1996. And over most of that time, there have been a lot of rules that made them inflexible, but those changed throughout the years. And one of the big ones is to allow 529 assets to be used for beyond college, thinking K through 12 education, vocational schools, things like that. You can also use it to repay up to $10,000 in student loans. But in more recent years, the Secure 2.0 Act is changing some key rules. So let's talk about that. Now, the first one is a new rollover rule that says if you don't use the money, the beneficiary of the money, it doesn't go to college, doesn't really use the money, you can roll those unused funds into a Roth IRA for them, and up to $35,000 limit per beneficiary. That's a nice out, Luke, that helps with that flexibility. Now, there are a couple other rules about that. You cannot roll over contributions that are made in the previous 5 years, and it has to be open for at least 15 years. So it's not something you can do and just in a couple of years roll over. It's saying, hey, if you've started early on in the kid's life, they get to college age, they graduate from high school, they don't use it for a few years, it's open for 15 plus years, you can actually start rolling that over. So that's the big one, Luke, in my mind, but I know there's some others as well.
Yeah, one of them is that there's improved treatment for grandparent-owned accounts. So previously, distributions from grandparent-owned 529 plans could negatively impact federal student aid eligibility. But these new rules kind of eliminated that impact, but the implications for institutional aid via the CSS profile still remain.
Yeah, so about 11% of 529 accounts were owned by grandparents, and then you have to add in those that are owned by aunts and uncles. This kind of applies to them as well. And so this kind of changes that rule, because I know that's one thing a lot of people worry about is, okay, I'm saving for college and we have these accounts, but it's going to count against their financial aid. And for some people, especially those whose parents maybe don't make a lot of money, but their grandparents and other family members do make a lot of money or have a lot of money and are helping with that the amount that could count against financial aid certainly matters in a big way. Now, there are contribution limit changes as well, and I think this is the most interesting, Luke, is that while the amount per beneficiary is going up from $17,000 per parent to $18,000 this year, so $17,000 last year, $18,000 this year, they're changing the rule. The IRS is launching what is called the super fund option, which allows for up to $90,000 in 2024 to be put away for each child. So totaling per parent, that's total up to $180,000. Now, the caveat is they cannot make a contribution for the next 5 years. So it's basically front-loading 5 years of contributions, which is nice. We always say the sooner you can get the money in to start investing it, the better it's going to grow. So that's certainly a really, really good option for most people who have the money. You have a new child or grandchild, you have enough money to do that super fund funding. I would certainly take that option. That's something that's quite enticing in my mind. What do you think, Luke?
No, it certainly is, because really the thing that you can't get back in terms of investing is time. Mm-hmm. So if you do have a child that was just born and you want to super fund, that would certainly be a good way to do it, right? Because the power of compounding is the most powerful thing for your investment. So being able to front load that, even though the nominal dollars you're putting in would be the same over 5 years, definitely putting it in as early as possible is going to be the most beneficial for your child, should you be able to do that financially.
Yeah, and if you think of the rule of 72, right? Child's born, you put that money in. You say you just earn 7.2% per year. Let's call it 8% for rounding. that account is probably going to double between the time they're born, double twice the time they're born and they go to college, right? Between 0 and 18. So if you can do 8% per year, which is doable for sure, that account's probably going to be well north of $700,000, and that's a nice chunk of change to get to college with, and that doesn't include additional contributions after that 5-year mark. So I really like that new rule and a lot of cool changes, and 529s continue to just become better and better options for saving for college. Now let's keep things moving and play another listener question from 888-99-CHART.
Hey, Justin and Luke. This is Art from Tucson, calling in today about a small cap or a micro cap. It's called DNOW Inc, ticker symbol DNOW. It's in the petroleum refining space and also does maintenance and repair of pipes and valves and other infrastructure connected to the petroleum markets. The company as a whole, and where a good buy point would be. It had good earnings, so it jumped up, and it seems to be maybe stabilizing now a little bit, moving sideways. Just wondering what you think, and thanks for all you do for us, and I'll listen on the podcast. Thank you.
All right, looking at DNOW. DNOW is the symbol, $1.5 billion market cap here, Luke. And what they do is they distribute oil and gas drilling, production equipment through 170 locations in 80 countries. So a global name, even though they're not that big, it's certainly in the wheelhouse because we know that oil and gas drilling worldwide continues to be pretty strong. What are you seeing on the balance sheet front and earnings trend front?
They have very little debt, about $63 million on that $1.5 billion. Their cash flow improved over the past year and a half, and their profitability has been pretty steadily improving since the end of 2020. Looks like they had a big jump in price in February. I'm not sure, but that was probably related to earnings, given that they're going to report most recent quarter earnings on May 10th. Given that we're 5 days out from earnings, I tend to always advise not hopping in now because you have that earnings positioning. It could easily go either way, for or against you, but certainly they're very low levels of debt. They're improving cash flow, they're improving profitability, and upgraded earnings sentiment over the past couple months is a positive for this name.
Yeah, it's supposed to earn $1.07 next year on a $14 stock. So you're talking about 14 times forward-looking earnings. Not too bad. Return on invested capital, 27%. Now, what I will say is that historically, they're not nearly this profitable. So you have to watch for a longer-term reversion to the mean. But we know this industry is booming to a degree, and that's why the earnings announcement in February certainly brought the stock back into a bullish position technically. It was below all of the major moving averages before that earnings announcement, around below $10 per share, and it's been consolidating in the 14 to 15 range now for 2 months. And I think waiting for that earnings announcement. I agree with Luke, stepping in front of that earnings announcement can be an issue, especially for these volatile small caps, because clearly there's a lot of bullish sentiment around it after that earnings announcement in February. And if they don't meet those expectations, you'll see this take a big step back. But I like the fact that they don't have any debt, actually net cash on the balance sheet. They're very profitable, and free cash flow is near an all-time high. A free cash flow yield about 15%. That's very, very healthy. So I like it, but I would wait for earnings to get a confirmation there. And here's another question from our InvestTalk YouTube channel. I don't know what the handle is. I can't pronounce that. But it says, since you mentioned SMRs, what do you think of BWXT as a play on them? I already have a 1% position. Should I look for opportunity to pick up some more? Now, this is another name that we own for clients. We've owned it for some time, and it continues to remain in a bullish position. And they have they have their hands in the nuclear industry. They manufacture power generation systems and nuclear components for the U.S. government, industrial, and utility sector. Not a big dividend yield, about 1%, but earnings continue to trend higher, and it's a consistent performer. It has gone up a lot since we bought it, Luke. Is this a time to get in for a new investor, though?
I'm not sure it's time to get in for a new investor. It looks like its forward-looking PE is about 30 times. Its 5-year average is about 5 times. I mean, its cash flow has been pretty stable. Its margins have been shrinking a little bit. And like you said, it's up pretty significantly. It's up 51% in the past year. So certainly I don't see anything that tells me you should sell this name if you hold it. But opening up a new position at this point in time, I'd maybe hold off a little bit, keep it on your watch list.
Yeah, and I think we have earnings coming up soon too. So I love the space that it's in. Obviously, we own it for clients. We're not quick to trim it, but obviously would want a bit more of a pullback. Maybe into the high 80s would be a great place to pick up some shares. Thanks for the comment. Now we're moving into our final break. So get your questions in now at 888-99-CHART.
The stock market is constantly changing, and serious investors want a way to get the latest news and unbiased investment insights. Welcome to the InvestTalk podcast.
Did you love today's InvestTalk episode? Well, we want to hear from you. So drop your investing questions in the comments below, and your question could be the star of our next segment. Subscribe and stay tuned to see if your question gets answered by us. Dive into the comments now and become a part of our next conversation.
We're here to answer your finance and investment questions. So make sure you give us a call at 888-99-CHART.
Hey, Luke and Justin. Bill from Philadelphia here. Calling about FSLY, ticker symbol FSLY. They're a cloud platform, and they just had earnings. Numbers weren't that bad, but the guidance, I think, was. They projected slowdown, and it dropped about 35%. Right now between $8.50 and $9. Was thinking of getting in and, buying some shares because I think this could be a pretty good one once interest rates do finally come down. I think right now it's 2.5 times sales that it's trading at, so it seems the valuation is pretty good to get my toes in. I'd love to get your guys' thoughts and love what you guys do. Thank you so much.
All right, this is FSLY, FSLY. It went public in 2019, around $21 per share. Boomed during the pandemic era, hit a high of $134 per share. Now we're down into the single digits after this recent earnings announcement, $8.78 at the close today. They've never made money, Luke, on a yearly basis, but they are expected to earn 6 cents next year. Is that a lie? We shall see. But the chart is certainly telling us that is a lie. What are you saying? Is this cheap enough, or is this a Ponzi name that's going to zero?
Seems to me like the thing they're best at growing is their shares outstanding. It started at 90 million in 2019. Now it's up to about 140 million. So it seems like it's a nice little dilution going in there for those people that were unfortunate enough to buy it at 126, which was near its all-time high. When you see a chart like this, it's the market's telling you something, and the market isn't telling you this is a good deal. The market is telling you stay away, because plenty of people thought they were dipping their toes in at 126, and now they're way, way, way underwater.
Yeah, and this fell from 126 all the way down to about in the mid 40s in mid 2021, and probably people were thinking, oh, it's cheap now, and now it's single digits. So, it's always about the quality of the business, not just the growth. And yes, they are growing top line at a fairly nice clip. But they're doing it at negative operating margins, negative 37% operating margins, return on equity, negative 13%. The simple answer is no. Run for the hills. Run for the hills. This is a Ponzi name that you want to stay far, far away from. Now, speaking of that, let's talk a little bit about TikTok. And Luke, a lot of people are digging in. A lot of people are shaping, a lot of young people are watching TikTok and shaping their view of the overall economy. They're trying to keep up with the Joneses in many ways. They're trying to. There's a lot of doomerism in TikTok where they're talking about how the world's going to come to an end and everything's going to crash. But at the same time, they're trying to get you to buy the latest and greatest gadget or thing that's hot, from Stanley Cups to many other things that are out there. And there's A lot of money dysmorphia is kind of the new term that's creating. So, is this a level of nihilism that is being created by TikTok, or do you think these are lasting trends that Gen Z will carry into their 30s and 40s?
I think it's too early to tell. I think what this does is just create one more echo chamber. I think people have, because of social media, this warped idea of what other people's lives are like. And sometimes they try and reach for those lives that aren't even real at the expense of their long-term financial health. I think one of the biggest concerns is certainly, as well, the fact that this is nothing more than a sales mechanism. That's what TikTok is, right? It sells you people's items. It sells you people's ideal lives. It sells you all these things that at the end of the day are just massive ads. So I know a lot of people are up in arms about TikTok. Certainly there are some national security concerns associated with TikTok relative to other social media websites, but I don't think we should discount the wholesale bad effect that social media has had on a lot of things for Gen Z and in my generation as well. I don't use TikTok. I'm not a TikToker, but certainly I can see some of the problems that it has created, and that carries over to financial wellness as well.
Yeah, because what you're seeing is that the young generation is taking on credit card debt. Over the past 2 years, Gen Z, those between 1997 and 2012, doubled their non-mortgage debt, taking on average $11,000 in a non-mortgage debt. So that's typically credit card debt or pay-as-you-go, things like that. So it's pretty clear that TikTok is bad for your mental health and probably your financial health as well. Well, that about does it. I'm Justin Klein with Luke Guerrero, and this completes another InvestTalk program. We thank you for listening. We encourage you to tell your friends and family about our free podcast downloads, which you can find anytime at iTunes, Spotify, or Google Play. And be sure to rate and review on iTunes as well. And remember to tell your friends that InvestTalk podcast is now available in video form over on our YouTube channel. Just search for InvestTalk with 2 T's. Independent thinking, shared success. This is InvestTalk. Good night.
Hey everyone, if you enjoyed this video and want to see more amazing content, make sure you hit that subscribe button and turn on notifications.
Your support means the world to us and helps us create more videos that you love.
Subscribe now and join our community of savvy investors.